maybe hitting a bottom here. There's some people talking about that the housing market may indeed have hit a floor. We're joined now by Karen Weaver. She is the global head of Deutsche Bank's securitization research division, who says we're just in the eye of the hurricane here for housing. Karen, is that your view?
Well, I think that's fair to say. I mean, we certainly have made a lot of progress toward the bottom. We've had pretty significant declines. We have some markets where we've had more than 50% down from the peak. But I think it's quite early to be calling a bottom. And some of these positive reports we've seen, the green shoots, if you will, we look at as being more like crabgrass.
Right. We'll talk about the Case-Shiller report, because that's the one that startled everybody. It was either April or May. I forget which month we're up to.
I think it startled Shiller himself. And in fairness, it startled us. I think one of the difficulties is first of all, there's perhaps more pronounced seasonality in a down market. When you have less volume, the type of volume that does occur might have a little more seasonality. So there could be some issues on how we adjust for seasonality. But I think, moreover, we just have to be very careful about what we're looking at here. We're looking at 1 month data point, a 0.5% increase in the index. And that index is also what's called a paired series index. So when you're looking at any given market and you're trying to create enough pairs to create the series, it's a very small amount of data to time a turn on.
Right. It may well be a mix issue or something. That's one of the arguments, is it's just a mix between foreclosures and actual happy open market sales. So what happens? Let's say that, in fact, housing bottomed miraculously, and we start from here. I still think there's a consensus that it's going to be a V-shaped recovery. We're just going to bounce right back. And as you look back at other housing collapses, what's likely to happen there?
Well, housing markets tend to be fairly slow moving, which has been a positive thing in terms of how slowly they correct. It's a little less jarring. But when we look at historical downturns in a study of 17 OECD countries, the typical time frame from the peak of prices to the trough is about 4.25 years. So in markets like Phoenix and San Diego, they're pretty close to that. In a market like New York, we probably peaked about 2 years ago, so we have a lot further to go. But peak back to the prior peak takes about 10 years. We don't see, based on what's currently on the horizon, any reason why that would be speeded up here. A possible exception would be if we got strong wage inflation, and that could be helpful, obviously.
Right. I don't see that coming down the pike anytime soon. And I know that the Fed also recently did a study about that Boston housing market after its boom and bust in the 1980s. And some of your researchers say you don't think we're going to do as well nationally as they did in Boston in terms of the length of recovery and the amount of foreclosures that they saw. What's the difference?
Well, the study that was done, and it was done by the Boston Federal Reserve, it was a very good in-depth study, a loan-level analysis of when people default. So it looked at those people that had negative equity, so if you will, their default option was in the money, and it looked at how often they default. And what it showed was that cumulatively about 7% of the people who had negative equity defaulted. The good news is, of course, 93% of the people with negative equity didn't default.
So people will do anything to stay in their home, effectively.
Which is what I think we've always sort of felt intuitively, and is why mortgages are so highly creditworthy and such good raw material to make securities from, et cetera. The difference, however, is if we take that 7% number and say, aha, that's the number we should assume today, is that there's two differences in that Massachusetts experience and where we are today. One is the universe of borrowers is far riskier today, and second, the stress test, the environment we're in, is far more severe. Unemployment peaked at 9.1 in that Massachusetts experience. We have unemployment of 12% in Michigan, 11.5% in California. The peak to trough in home prices in Detroit was about in Massachusetts was about 16%. We have Phoenix down 54%. So a much worse stress than what occurred there.
People are deeper underwater, essentially.
Exactly. But in addition to that, the universe of borrowers is far riskier. Late 80s Boston, again, the timing of the study, or Massachusetts, you're looking at prime borrowers who probably put down a real down payment, were fully underwritten, fully documented. They took out fixed rate 30-year mortgages. They probably didn't have 9 credit cards. And so the universe of borrowers was more creditworthy. So when we look at the 7%, we say that's clearly a floor for what we can expect this time around. It's certainly going to be worse given those two factors, a weaker borrower and a more severe environment. The only other thing we can say is it's not going to be more than 100%. Somewhere between 7 and 100.
So 7 and 100.
Great.
All right, Karen, thanks very much.